Every day, millions of tons of goods cross the oceans to keep the global economy moving, and almost all of that physical trade is facilitated by a single intangible operating system, a piece of paper printed in the United States. The US dollar is simply the latest iteration in a long lineage of dominant currencies. From the 16th to the 19th centuries, the world's merchants priced their goods in the Spanish silver dollar, backed by the vast metal reserves of Spanish America. As global power dynamics shifted in the 19th century, London became the financial center of the world, and the British pound sterling took over as the preferred medium for international exchange. The historical pattern is remarkably consistent. The nation that controls the most powerful military, operates the largest economy, and projects the furthest geopolitical reach, ultimately provides the currency for everyone else. A global reserve currency is never chosen by an international vote. It is the inescapable byproduct of economic gravity and imperial reach. By the late 1800s, the center of global production had already begun to shift across the Atlantic. The American industrial base was expanding rapidly, producing a massive surplus of goods and generating immense wealth. Then came two world wars. The conflicts completely drained Europe's financial reserves, physically destroyed its manufacturing capacity, and severely crippled the British pound's standing on the global stage. The United States, insulated by two oceans, emerged with its industrial machine entirely untouched. As Europe bought American supplies to rebuild, massive wartime gold inflows rushed directly into U.S. vaults. This created an extreme structural imbalance. Europe had immense debt and destroyed infrastructure, while the United States held the vast majority of the world's productive capacity and precious metals. The world had no choice but to pass the baton of financial dominance. By 1944, America held the physical wealth necessary to backstop the entire global economy, making the dollar the only viable bedrock for the post-war era. To formalize this new reality, delegates from 44 nations gathered at the Bretton Woods Conference in 1944 to design the post-war monetary system. Looking at the structure they built, the mechanics were straightforward. International currencies were pegged to the US dollar, and the dollar itself was pegged to gold at a fixed rate of $35 an ounce. But the system contained a fatal flaw, known by economists as the Triffin dilemma. To provide the world with the liquidity it needed to trade, the United States had to run massive deficits, eventually printing far more paper dollars than it had gold in its vaults. By the late 1960s, foreign leaders like France's Georges Pompidou realized the dollar was heavily overvalued. They aggressively began cashing in their paper dollars, demanding physical gold from the Federal Reserve. Facing a total depletion of the nation's gold reserves, President Richard Nixon acted in August 1971. He suspended the dollar's convertibility into gold, effectively ending the Bretton Woods Agreement. Severing the tie to gold should logically have collapsed the currency. Instead, it unleashed a far more resilient financial architecture, one based entirely on network effects and international trust. The dollar survived the 1970s because it was already deeply entrenched. It had become the only financial language the global banking system knew how to speak. This stickiness was largely due to the eurodollar market.
Trillions of US dollars were held in foreign bank accounts, completely outside the jurisdiction and regulatory control of the American government. This offshore plumbing meant a German manufacturer could buy parts from a Japanese supplier and settle the transaction entirely in dollars, without a single cent ever touching American soil. Global commodity markets realized the efficiency of this system. They standardized their pricing models on the dollar. Oil, the most critical resource on the planet, was traded almost exclusively in U.S. currency. Oil exporting nations accumulated massive revenues from this arrangement. Because the dollars were universally accepted, these nations recycled their profits right back into the global financial system to fund their own development. The modern dollar does not derive its value from a precious metal. It maintains its value because it is the inescapable, structural necessity of global trade itself. This global reliance grants the United States an immense economic advantage, a concept economists refer to as an exorbitant privilege. This chart visualizes how that privilege functions. During times of heightened geopolitical risk, the spread between U.S. borrowing costs and other developed nations actually widens. When the world gets nervous, capital floods into the safety of the dollar. Because central banks worldwide need dollar reserves, they park their excess capital in U.S. Treasury securities. This guarantees a permanent baseline of demand, allowing the American government to borrow vast sums of money at artificially low interest rates. This financial infrastructure also provides immense geopolitical leverage. By controlling access to dollar clearing networks like SWIFT, the United States can effectively lock adversaries out of the global economy. Operating the world's reserve currency allows a government to seamlessly finance its own debt while projecting global authority, all without firing a single shot. With such clear advantages, the pressing question is whether the dollar can lose its grip. The heavy weaponization of U.S. financial networks has actively motivated rival nations to seek out alternatives. Relying on a single nation's currency has always been a point of friction. At Bretton Woods, economist John Maynard Keynes strongly advocated for a neutral global reserve currency to prevent exactly these kinds of imbalances. Modern leaders continue to echo that warning, pushing for alternatives like the euro or the Chinese yuan. However, these challengers face fatal limitations. They lack unified fiscal policies, or they operate under strict capital controls that prevent money from moving freely across borders. Still, looking at this data on global foreign exchange reserves, a gradual de-dollarization is undeniably underway. Emerging markets are heavily purchasing gold, and the U.S. dollar's share of central bank reserves has slipped to a 2-decade low. Yet an overnight collapse remains highly improbable. The switching costs are simply too massive. The deep liquidity of U.S. capital markets and the established trust in American property rights keep international participants firmly locked into the current network. The dominance of the U.S. dollar is the combined weight of historical momentum, global debt architecture, and institutional trust. Until a challenger can provide that exact same utility at a global scale, the world remains permanently tethered to the American financial operating system.